Boom, 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 head smack.
Yeah, yeah. Who likes feet? What director is it? It's Quentin Tarantino. Remember when we were watching From Dusk Till Dawn and there's all the feet? And that's, yeah, I mean, it's so obvious that he's got like a weird...
A foot sucker.
Yeah, it was that guy. Like, he kept putting her foot in his mouth. It's gross.
Don't you like how he found a reason to put that in every situation? He's like, oh no, not again, I'm stuck. You gotta put the foot in my mouth. Hello and welcome to the Thymble podcast. This is Tyler Latch and Ben White here. Today we're going to be talking about mutual funds after our previous discussion of bonds and fixed income. We'd like to go a little bit more into our portfolio management and expand that range and diversity.
Is this an OxyClean commercial or
Let's
is this
go.
a podcast?
It's up to you, Ben. You can carry it on, bro. Take the rest of it away.
But yeah, so yeah, we're gonna talk about mutual funds.
He wasn't ready, dude. He doesn't have these intros prepped like I do. Let's go.
No,
Let's talk.
I'm not. Never
Let's
mind.
talk.
It's fine.
Diversity.
Yeah, diversity.
And investments.
Are we talking about diversification already?
With mutual funds?
I guess that's it's kind of part and parcel.
Cool, I got an email.
Oh, gotta check your email. Okay.
Oh, good, yeah.
All right, thanks. Yeah, so we're gonna talk about mutual funds, which hand in hand with diversification. We're gonna talk about a couple different kinds of mutual funds. And so first, I mean, like, I feel like mutual funds is something that a lot of people heard of, a lot of people are vaguely aware of, but might not truly understand what's going on with those. So like, you want to give us like a pretty simple definition?
So essentially, like we were saying, it involves that diversification, that definition of what we were talking about earlier, and it's a combination of all sorts of things. So like equities, commodities, bonds. If you want index funds in there, if you want foreign investment, it's a whole conglomeration, and essentially it's put together and packaged by one of your brokers out there. So whether it's Schwab, whether it's Fidelity, those sort, and they'll put all these together, and it'll be aimed towards certain things. So maybe you want, like we were saying, foreign investment, and then all of these equities, commodities, everything is based on foreign economies. Or maybe say you want low risk, and so we're investing in munis, government bonds, and ETFs, ETNs, that sort. So it's all tailored to, but you can sort of pick and choose, and it's meant to be one centralized market, but still getting that diversification that we're looking for in our portfolio.
And so like the diversification, I mean, we've already talked a lot about how like when something is able to be tailored to your own preferences, that's very nice, and that's diversification in one sense. But the other thing that we talk about diversification is due to risk, right?
Mm-hmm.
So, I mean, one of the main advantages of having a diversified portfolio through the use of mutual funds is an example, and we're going to obviously talk more about mutual funds. But, when you have enough diversification in your portfolio, you essentially can mitigate most risk of individual pieces of your portfolio. Yeah. I mean, of course, the market always has risk, and so if the general market is hitting a rough patch or it's in a boom, that's gonna either hurt you or help you. Yeah. But I mean, as far as like, if I have 20, let's say I have a mutual fund or I have a portfolio of just 20 stocks. Mm-hmm. Maybe I don't have any other kind of asset or commodity. Yeah. If one of those 20 starts failing, there's 19 to make up for it. Yeah. Now, of course, it's not always that simple, but that's just an example of how diversification really helps us. So even when you start diversifying outside of just diversifying within stocks, it becomes even more secure. You have even a better chance of having that positive return. Yeah. And so that's one of the nice things about mutual funds, like you said, is that you can have different kinds of assets.
Yeah, because then you compare, like you were saying, with the equities, we can suddenly have like copper commodities or gold commodities in there if you want to buy into the like crops, corn, indigo, that sort. And then you can add to that things like the bonds we were talking about. So if you want exposure to FDIC and government backing, then you just plow those in there as well. And so
you don't have to just dump all of your money in gold and pretend like that's a great investment.
Yeah, great investment.
I don't know why, I just think that's funny. But
why does he have the phone out? Cameraman is so unprofessional.
No, he's filming.
No, he's not.
This is his personal collection.
I know it is. He keeps an archive for his own usage. Continuing on.
It's making him laugh, so it's gonna pick up. But anyway,
what was that, dude?
So, but another nice thing about mutual funds is like you can be more hands off. Like you have control over where your money is still. Like when you choose to put your money in a mutual fund, that is
how much goes into it and which one.
In which one. So that's like your main source of control. But once it's in the mutual fund, you have like highly educated and trained professionals, if you choose a good mutual fund, which it's not that hard to figure out. The good mutual funds, like the ones that are.
And you can look at the performance of those over time, and especially there's a number of niche market ones that are smaller brokers, and then there's those large ones that we were talking about previously, and it's all where they see their own risk and allocation for that.
Yeah, and a lot of times, like the mutual funds will tell you what their strategies are.
Yes.
I mean, there's a lot of transparency involved, so that's always nice. But basically, one of the big advantages is you don't have to sit around watching your portfolio.
Yeah, you have a professional analyst or analyst team gauging, each individual portfolio and the accompaniments of that.
And when we're talking about our daily lives, and we all have tons of responsibilities and things that we have to worry about, we don't want to have to constantly be worrying about.
Unless we're a day trader, we can't, afford the same time and commitment as that day trader.
Exactly. So that's one of the biggest benefits of mutual funds, and I think because time is money. I mean, time, and so, I know it's cliche.
I'm thinking of something. Sorry.
What are you thinking of? Is that like a movie?
Nothing, go.
But, time is one of our most valuable assets. And so being able to save time. What is so funny about time is money?
No, just go on.
What is it? No,
go.
Get it out. You're going to keep laughing every time I say time is money.
It's not that one I'm laughing at. Just
what
go.
Are you laughing at?
Don't worry about it, just go.
So I got something on my face? Some schmutz?
Yeah, you got this.
Oh, my beard. This is nice.
I thought Rat crawled up there and died. My bad. I was looking the wrong day.
Damn. All right. Fair enough. See, now we're roasting each other on the podcast.
No, I guess that's what it turned into.
All right. I'll
Next
keep
topic,
that in
bro.
mind.
Come on, let's keep this pace going.
Okay. So now I have to be on edge. No.
He wasn't ready, dude.
I wasn't ready for a roast.
Yeah.
I was holding him back. No. All right. So that's one of the big things. I think when it comes to especially our viewers, and I know I think I relate to this a lot, but I don't want to be a day trader.
Yeah.
I'm interested in finance. I'm interested in investing. I want to have that income.
Yeah, and still have that
growth.
commitment, but
yes, I still want to have that commitment. I still want to know what I'm doing, but I don't want to be sitting around looking at
day in and day out.
Yeah, all the time. It's just it's not fun for me. Now it might be fun for some people. I mean, some people are it could be their career.
Yeah, but those of us who don't make that our career.
Yeah, exactly. You still want to be able to have the benefits. Now, of course, when you are putting money in a mutual fund, the managers aren't managing your fund for free.
Yeah.
So there is the fee associated.
Those
with it.
Commitment fees. Yeah.
But I mean, I don't know about you, but they're not unreasonable.
I mean, it depends. Again, if you're investing in larger, like a hedge fund is almost what you could say is like a really large mutual fund for super wealthy investors out there. They're going to take, a percentage off the top of whatever you make that year. And that's how even the smaller mutual funds work, a percentage off the top usually, and then an upfront commitment fee that you'll pay of X dollars, and that's every year.
Yeah, but it's manageable. It's not going to break your bank. You're not going to feel like when you get a paycheck and it's like you get taxes, and you're like, oh shit, like that's half my paycheck. Maybe not half, but you know what I'm saying. It doesn't. I don't think it feels as bad as that. Like I think getting your paycheck and seeing the taxes getting taken off is way worse than seeing your mutual fund fee. That's just my opinion, I guess. But I think it's relatable. So like you said, there's the different kinds of mutual funds. That also comes to there's the different assets that could be involved in that mutual fund, but there's also different levels of risk, right? So that's still how we constantly talk about how being risk averse, being versus a more risky person, that still comes into play here because some mutual funds, part of their strategy is to invest in risk, and others are just like, no, we just want that steady growth. So even with mutual funds, that's still something you want to think about and say, okay, do I want more of my money in riskier funds or less risky?
Yeah, like you could say, for instance, like let's go with tech. You have an entire mutual fund dedicated to tech. So say we're piling on semiconductors, we're piling on like information as a service, platforms as a service, all that sort, cloud-based software, all of that into one. But the tech market seems to, move within itself, and you're going to see, it all goes up or all goes down. And so that's what you don't want, that overwhelming exposure, unless you're ready to take on that for more return.
And I mean, you see in like the news and stuff, you can read about, like, there's always something about tech stocks are doing this today because they are so independent in a lot of ways, right? But even then, even if you want to invest risky, you can have money in multiple mutual funds. Like you don't have to put all
that way. Again, diversification, because you're balancing one. Say you have tech, well then maybe you also have retail, maybe you also have let's go like oil and energy. Like all those are very volatile by themselves, but at the same time maybe they move differently.
Yeah, exactly. So you have diversification within the mutual fund a lot of times as well, but then you can even get more diversification by having multiple mutual funds. And I know if you go to certain tools, like I don't want to name any specific tool. Well, I mean, there's like Fidelity, there's E-Trade, like all these different companies. Pick the one. We talked about that in the previous episode. But they make it relatively easy to look up this information about. Is this a riskier mutual fund? What are the assets within this mutual fund and things like that. So again, there's a lot of information out there that's relatively, just do a Google search. It's out there. And again, think about what you like, what feels right to you, the things that you're interested in. I think it kind of goes back to when we were talking about stocks, about how, if there's a certain area, a certain industry that you are more passionate about, then, look into putting money in a mutual fund in that industry, or look for mutual funds that have that, assets from that industry in it, if that makes sense. You think, what else do I want to say about?
I think a good point to start to talk on is the indexes that we were incorporating within the mutual funds. So when you hear this idea of an index and you really look toward that diversification, not just different mutual funds, but in one mutual fund, you might find one index alone. So what an index is, do you want to go into that?
Yeah, I was just going to say. So why don't we talk about like what is an index fund and why do I care?
So essentially, let's say we hear the S&P 500. It's the top 500 companies out there in terms of assets, in terms of sheer size in the United States economy, and those that are over here incorporating themselves as foreign companies as well. So the top 500 companies essentially performing in the US,
best of the best
U.S. market, yes. And so you hear that, and you're investing in all 500 at once. And so it's a very small fraction of each of them combined in this investment fund. And so essentially say you'll put $1,000 on it, and it tracks all of them at once. And they all move different ways, but nonetheless, by tracking the entirety of the market with that allocation of $1,000, then you're assuring yourself or insuring yourself against a lot of the risk that we get just from investing in a few of them or one specific market.
So basically, you are almost, I should never say completely, but you're very heavily mitigating firm risk.
Yes, firm risk.
The risk of the firm doing poorly, and instead you're left with really just market risk. Which, of course, it's a very real thing, and it's not to say that
2008. I mean, it's not that the index funds aren't always going to be profitable, but on average and on the up and up, the S&P 500, the Russell 3000, they're all continually seeing average 8% growth a year.
Yes.
Over time, you'll see ones with like 15%, and then ones negative 5% growth. You'll always see that, but over time, it's that 8% averaging that you're getting in return, and so that's really good. Yeah,
so I mean, the index fund, it's not a mutual fund, but it's similar in a lot of ways in that it's creating that diversification, and you can have those index funds within a mutual fund.
Exactly, yeah.
So it's like a Russian doll, like just stacking
one after another after another. So the allocation can sometimes become confusing, but nonetheless, you want to pay attention to what you're investing in, or how your mutual fund's investing for you, because there is all this risk assumption, there's all this knowledge still that you want to have an understanding of where your money's going.
Yeah, absolutely. And you will always, you can ask where your money's going. I mean, you can look it up. Like it's not, they're not hiding it.
Yeah, it's all disclosed as to where it's going.
And it has to be disclosed.
Yeah,
right? I mean,
SEC regulation.
Yes, it's regulated. So no one's trying to pull the wool over your eyes. Especially if you go with a well-trusted mutual fund.
Well, I don't know about you because you have that rat's nest there, which is cool. When we're looking at mutual funds and indexes as a whole, there's this idea of, how can we get rid of these commitment fees, these percentages off the top in general? And a big part of that is this idea of, electronics. And so now everything you hear, ETFs, so electronically traded funds. Yep. And essentially that's the exact same thing as one of the indexes or as one of the mutual funds, but online, traded immediately by your broker. It's probably $5 if you want to make a trade to buy into it or sell it off, and then that's the only fee you pay for the entirety of you holding that item. Yeah. And so it's clean, it's simple, it's the exact same go through your broker for, and it's all electronically traded. So things are constantly updating, algorithms, all of that sort. It's where a mutual fund at some points, if they don't necessarily have an algorithm, which almost everyone does at this point, it could still somewhat be hand traded depending on what they're investing in.
Sure. So I think if you listen to any podcast about finance or like you look in the news, like there's tons of stuff about how ETFs are the thing now, and I mean for good reason though. It's not a fad. Yeah. I mean it's very popular, but it's not for no reason.
Cheaper, more transparent, and it's easier to get everything done quick.
But it also still kind of relies on tried and true methods. It's not like we're not reinventing the wheel with ETFs. It's a great option, and I think any professional will tell you that it's a good avenue to look into.
And you'll hear the big one out there is Vanguard, and so you'll maybe be able to invest FTSE 100, so the top 100 in the London exchange right now, and Vanguard's investing now on your behalf, electronically done, and again you're only putting $100,000 forward for that exposure to the entirety of those 100.
And so it's pretty low capital investment too. I mean $100,000.
Yeah, I mean not much at all, even less than that for a good majority. Yeah.
So I mean that's something that we all work, we can save that amount of money and then put it in there. So that's actually great. I mean, I know when we were talking about stocks, I was talking about I think having $3,000 to $5,000 of an initial investment is best, but for ETFs, hey, maybe
you can start as low as 50.
Yeah, absolutely. And I know when it comes to people just getting into it, the lower the capital investment required, it's nice. I mean, it's easier to get started, and you can start learning quicker without having to wait around for capital.
And on top of that, to tag on to our previous episode with the bonds, it's the electronically traded notes, the ETNs. And so the difference between a bond and note, the note's actually only for 1 year. So if you want that short-term exposure, which we didn't talk as much about maturities, if you want shorter-term exposure, then you would go toward that. If you want a bill, it might be a little bit longer. And if you want the bond, you're probably looking at least 5 years for that maturity to actually sell off.
Yeah, absolutely.
I mean, a lot of this stuff is recap because it's all once you start to hear one investment, you start about
it builds, but that's good though. I think it's good
because that's the
things we talked about. Yeah, it's good that we are saying similar things. I mean, they're different investments, but they deal with similar concepts, and that's how you learn stuff. Is like you said, familiarity and practice as well. But I actually don't know from personal experience, but can you simulate mutual funds? I would assume, right?
Essentially it's very similar. You can buy directly into the mutual fund. You can buy directly into the indices if you want that S&P 500, Russell 1000, whatever it is.
But I mean, is there simulations out there that I can
to put together your own portfolio?
Yeah, if my portfolio of mutual funds, I can include those in a simulation portfolio.
Essentially, yeah.
So that's
again, if one's a little bit more complex, especially if you get up to hedge fund level, you can't do private placements into companies that you don't have access to. But nonetheless, most of the publicly traded things you can invest right into with that portfolio.
Cool. Mm-hmm. So again, practice makes perfect.
Practice makes perfect.
Play around with it, learn what works for you. Mm-hmm. I'm doing a simulation now, and it's just stocks. So I guess this is a little off of mutual funds, but we could talk about it anyway. But I'm doing a simulation now, and I bought EA stocks at the wrong ass time.
So a year ago.
No,
now,
before Apex Legends came out. Yeah. I was like, okay, I think Apex is going to do well, and it has been doing well.
But it's not going to bring up the stock.
But it's not bringing up the stock enough. I hope not though. I hope it. Because if not, I have to sell and take a loss on my stocks.
Or you can ride it out.
Yeah, that's what I've been doing. Mm-hmm. But it's sad to me. I'm looking at their lineup. This is getting nerd video game talk, but their lineup. It's making me sad.
Yeah, no, they're really, in my opinion, not.
I do think they're undervalued in ways though, because they still have the biggest sports franchise video games out there that make millions of dollars. I mean, they sell
do, but
millions
like
of
right now
copies.
it's all stagnating in my opinion.
Fair enough. We'll see how it goes. Luckily, it's not my real money in the EA stocks. So, but that's a good example of why you should simulate, is because then you look at, okay, you learn things. Like you come away with lessons.
Yeah, should I have kept my money in longer? Do I feel it would have made a better return elsewhere? Should I have never invested to begin with? All these questions.
And so it's still good to play around with. That's just a personal anecdote. But I think with that pretty much covers mutual funds. If there's anything that you have more questions about as a viewer, or anything that you think we didn't cover in today's episodes, please leave a comment, and we'd be happy to respond and help you out. We talked about all the different aspects of mutual funds and why they're a pretty good investment. We also talked about index funds. We talked about ETFs. And so, moving forward, keep that in mind. Next episode, I think we're going to talk about, I don't know yet, actually. We'll figure it out. You'll know what we're going to talk about.
Producer Rick will tell us.
Producer Rick will tell us what the next episode is. But whatever it is, I think we're going to go on a nice cruise together. And
have a romantic lunch across the ocean. I'm thinking maybe Mediterranean.
I was thinking Alaskan, but I think we'll take a nice Alaskan.
Listen, wherever you want to go, we'll take you. Remember, diversification. We can put your assets wherever you need.
We're going to talk about that on our cruise. We're going to take you on that cruise, and we're going to talk to you about finance together. Thanks for watching, everybody, and we'll see you next time.